helped put your face out there as the face of the firm itself. Did that give you a competitive advantage?
Well, you said so. I think it did, but we'll never know. But I think people were familiar with me and face. They knew that we would be honest people. At least I looked honest at the time. And so we delivered. And
I got to ask you about the zero commission thing you went to last week on equities and ETFs. It really rocks the world. You moved all of your competitors. You moved your own stock. What was behind that decision?
Well, you know, we joined the New York Exchange in 1981, many years ago. And so prices then, when we first came on board, we were about half price. We kept coming down every year to now. It was sort of the final solution for investors. We have a great deal for investors. You can buy and sell stocks for no commission. And that's what I really wanted to do. And I thought, just like other companies, we make our money on other relationships. You might want advice, you might want to have a fixed income or things like that. We'll make a little bit of money there, but commissions on stocks now are free.
Yeah. So where does this end? So you obviously commissions are an important part of your revenue, but you have a huge banking division that arguably is much more important revenue-wise, and you've got wealth management. What happens next? So do you go into your interest rates and say, okay, we're going to offer you a little higher interest rate on the bank? How do you keep? Where does this end?
Well, what we try to do is offer things that customers really want. And they definitely want lower prices. And so we've been a company that's been involved with that by using technology for many, many years and employing the benefits and the efficiency of technology. We have one of the lowest cost companies in the financial service business. So therefore, by being very thoughtful about how we spend our money, we can deliver great value onto our clients.
But this aggressive move on your part is sparking a lot of talk about more consolidation in the business.
It probably will happen.
Is there going to be 3 or 4 competitors? Is it going to be you, Ameritrade, Robinhood? Where does this end?
Well, it could be, and we don't know how that will unfold, but that's a very logical conclusion that will occur.
Is Schwab a potential buyer of anyone out there?
Well, certainly at the right valuations, we would do it, but we are really strong and very independent the way we do things. And so if it happens that's appropriate for our shareholders, we will do it.
Let me move on to the IPO market. You've seen what's been going on. We had a very strong first half of the year. We've had a little bit of trouble recently. WeWork had to withdraw over valuation issues and other things. One of the most interesting parts of your book was your IPO in 1980. Most people don't know this. You withdrew the IPO when you couldn't get the valuation you were looking for.
That's right.
You had to wait another 7 years. You did went public in 1987 very successfully, but you pulled it initially, just like WeWork.
We did.
Did you have any advice for WeWork about what they should be thinking about, or anybody else?
No one came to me for that advice, but I live right in the middle of where all this stuff is occurring in San Francisco. So I see all these dream boats going on in terms of valuations, and some are so unrealistic because the companies are still losing lots of money. When we went public, we were making money. So it's a different atmosphere today. There are a lot of losers, and I don't know whether WeWorks or whether some of the other companies, Uber, will they make money? I don't know.
Is it fair for them to be pushing back for the people, the CNBC viewers who are going to be buying these IPOs? Is it fair for them to push back on the IPOs? Are we overvalued in the private space now?
I would never buy a company like that has huge losses and no scene and no sight ahead of you how you're going to make money. I mean, you want to buy companies that have great values, and that means number one, they have to be growing in revenue and they have to be making money, and that pretty simple formula.
Yeah.
And a lot of these companies just don't make money yet.
We talk a lot about ETFs here. Schwab has muscled into the ETF space in the last 5 years. You're now number 5 from nowhere. It's really very
I don't know
impressive.
if we muscled in. We just offered great value. We had reduced the OERs down to something like near zero, not quite zero. And people are attracted to it.
How do you feel about that whole active versus passive debate? A lot of people are complaining too much money is in the passive space, but you've been a big advocate of that for years. Is there too much money there?
I don't think so. I don't think so at all. I think there's always price discovery going on all over the place, whether it's venture capitalists or Wall Street. Here in Wall Street right here where I am right now in New York Exchange, price discovery is going on all the time and analysis is going on. There'll always be some people who, like myself, when I first began in business, will try to evaluate companies, make assessments, and judge it and see if the price is right. So passive investing is clearly a path for most people. It's really easy. great diversification and low cost.
And you've been a big advocate of that. You started that Schwab 1000 fund, the passive fund, many years
1991.
ago. You were way ahead of that. Josh Brown's got a question over in Englewood Cliffs. Josh, go ahead.
Hi, Mr. Schwab. I'm a big fan of yours and also a client on the custody side, and I appreciate everything you've done to lower the costs for investing. I wanted to ask you about one of the things people mention when we talk about commission-free trading, that to some extent it's being subsidized by cash rates for the end clients that maybe are not optimal or maybe are lower than regular market rates. And if investors really just end up paying the same toll booth, a different sort of toll, what would be your response to that? How should we think about that when we use Schwab and other online brokerage providers?
Obviously, we as a company do make money in different, we're very large companies, so we have many different kinds of services to offer, and some we charge on for sure. Now, in terms of interest rates, if you want the highest maximum rate in terms of, and liquidity complete, you buy a money market fund, or you buy a fund that is, which we have some that are nearly 2% in terms of interest rate on money market funds. If you want to be in our bank, FDIC insurance, all those kinds of things that go along, free checking, free ATM cards, all those things is a very valuable service too. And so that comes sometimes with a little bit lower rate than you might find in a money market fund. So it's up to you to make that choice.
The average investor, though, one of the great parts of your book talking about what it was like in the 70s for the average investor to buy and sell a stock. What a better deal it is today than back then. Back then, to buy 100 shares of a $20 stock, it might have cost you $50, $60, 3-4%.
I was just looking at that yesterday. Just 5 years ago, you would be paying 10 times more in commissions and all the costs that go into buying than it is today. It's just unbelievable, the improvement.
And you led that revolution in the discount brokerage.
It took us about 15 or 20 years to do that. Didn't happen overnight.
Joe Terranova's got a question. He's in Englewood as well. Go ahead, Joe.
Good afternoon, Mr. Schwab. Thanks for joining us today. I want to go back to the active-passive debate. How much of this debate do you think really is just ultimately about cost? Active management really has the need to lower fees. And do you think the passive argument has been emboldened by this continued bull market higher that never seems to correct itself?
Well, I think it has to do with the robustness of the American stock market. We are such a great place for capitalism and success of free enterprise. And I think every company that trades is always thinking about growth, new innovation, new service, new whatever it might be. And so companies on average do grow every year. And so an index fund, a passive fund, you can participate that at very low cost, and it's easy to do. If you have the time to spend on analyzing companies, which takes a lot of time, you may want to pay for the service, which would be active managed funds. Me, for the average guy, I think passive funds, we started a fund in 1991, Schwab 1000. It's averaged about 9.9% compounded growth rate, compounded for all those years since 91. So it's whatever you want.
Now, there's a great chapter in your book where you talk about the financial crisis in 2008. You talk about your concerns about housing in 2007, too much credit sloshing around. Is there anything that raises your radar right now? Any bubbles, any suspicions? Is there anything that makes you nervous about the markets based on your 50 years of experience?
It doesn't seem like there's excesses at any portion of the economy to the extent you're talking about. I think some of the IPOs we've seen is very large valuations based upon no earnings. That's sort of an obvious place to look at. So you can avoid buying into those things. Wait until they start making it. But overall, I think the country is very diversified, east to west coast, central part of America. I think we have great valuations.
One of the things that I thought was most interesting was your discussion about crashes and how people mentally deal with crashes.
It's a behavioral thing that happens to humans. When things get really bad, we feel bad, and we respond sort of, some people panic, and that's the kind of thing you have to avoid in your investing. If you're going to be a successful investor, you've got to be above those kinds of emotions.
One of my favorite quotes in the book, panic is not a strategy. Stick with your investment plan and don't let emotions get the better of you. You must have seen a lot of panic clients in the 87 crash, the 2000 .com bust, the 2008 crash.
And before.
And why, we we talk about this all the time, why people behave this way. We talk about rational investing. We talk about buy low and sell high. And yet in panics, people don't do that. They don't buy low and sell high. They buy high and sell low. Why do they do that? And what can you do to, what can we do to stop that?
People measure their net worth as such. My portfolio's down. I've lost 50% of my money, a third of my money, whatever. I don't want to lose any more. So that is what happens to people. It's about their money. And boy, when you come to investing, it's all about growth. It's about letting things grow over a period of time, and you have to have confidence in the American economy. If you don't have confidence, you shouldn't invest. You should put all your money in the bank and forget about it. See, that's the wrong thing to do, though.
It's hard to get people to do that. One of the most depressing things in my career, I'm going on my 30 years at CNBC, the first quarter of 2009, we bottomed. We didn't know it, but we actually saw mutual fund withdrawals accelerate. By then, the market was already down 50%.
I know, it's crazy.
And unless you believe the U.S. economy was going to be a zero, my thought was, why would anyone pull out now? And yet the losses, the withdrawals accelerated at that point.
Bob,
That's when I became a behavioral investor. I said,
good.
What happens? What is going on?
What happens at that moment in time? You have all the newspapers are negative. You have all the networks are negative. You have every pontificator is negative about the economy, and all of a sudden, the sun comes up the next day, and all of a sudden the market turns. People have all exhausted on selling, and then a few smart people start buying, and then all of a sudden you start another bull market.
Did you have had any chance to ever pick up the phone and talk to individual clients when this kind of crazy?
Well, we sent out a lot of communications with our clients through those time periods. Not all were perfect timing. When we were down 40%, we'd send out an alert, say, do not sell. This is not a time to panic. Hang on, 6 months from now, you'll be much better off. That was a kind of view that we would take. And it turned out that way. But it's happened, not to me just one time, it's happened to me every panic that goes way back to when I started the business in the late 50s and early 60s.
I want to get your quick thoughts on the retirement crisis. I call it a crisis. I mean, the markets are up, so people are doing a little better. But the amount of money that the average, I'm 63, average baby boomer has saved for retirement is not adequate if you think of your personal savings.
It's not adequate.
I don't know what we can do about that.
And plus the fact they're going to live longer than they ever would have thought. So the only way you can do that right now is probably help your kids get started. Get them started, get an investment account, make sure they do their IRA account, their 401k account. All those things are free money and tax exempt. You've got to start someplace, and I think education, of course, is the number one way to achieve that. So our schools don't do it, our high schools don't do it, our colleges don't do it. I'm actually funding a course at Stanford on introduction to investment decisions. So this will be addressed to people who are 20, 21 years of age. But I wish more schools had these courses for kids.
Do you think we should have, every high school should have a course on basics of finance? What a stock is, what a bond is, what the Federal Reserve is?
We are a sophisticated free enterprise country. We should have an understanding of what that really means in schools.
Now, back in 2008, you were chair of the President's Council on Financial Literacy. Were you not making these recommendations back then?
We did exactly that, but it was a huge thing with 300 million people in the country, and people would rather watch maybe football than learn about financial services stuff.
One of the things that really came through in your book was the struggles that you had and your perseverance. I think that's the word I would associate most with you. The struggle you had in the beginning because Wall Street hated you. Discount brokerage.
We never got a dime from Wall Street.
They were rooting for you to fail. Then the difficulties raising capital. Yeah. Then the 1987 crash. Then the decision to sell yourself to Bank of America and to extricate yourself from that and eventually go public in 87. All the way I kept saying, oh my God, he's not going to make it. And at one crisis after another, one cost-cutting crisis, firing your friends and intimates who you've been with for years, how painful that was for you, and yet you persevered.
Well, it's a great story about an entrepreneur. And I had other people surrounding me who wanted to be part of this entrepreneurial trip. Yeah. We worked hard to really make sure that our clients get a great value, bring the cost down of investing, get more people to invest. And that's sort of the pursuit we've always been on.
Yeah, I guess just on there's a little piece at the end of the book about personal observations, about life lessons. What do you tell people who are dealing with a lot of setbacks like that, who are how you deal with burnout, for example, and because I saw that with some of your colleagues, they were just exhausted, the sheer effort to keep the organization going. Is there something motivating you can say to them other than let's
I
keep
don't know.
going? What?
I think it's just a matter of getting enough energy to make sure that you have friendships, other people, that you're not always dripping in your own sad story, that you're talking with other people of common mind and so forth, and you get a lot of energy from being friends with other people. I think depression is a terrible thing for lots of people. They get so into themselves, but make sure you keep a face out with your friends.
I want to ask you a question about why Wall Street is so bad at predictions. It's amazing to me, 30 years of not even watching analysts, but the Federal Reserve predict GDP even 1 year ahead. It's amazing how inaccurate. It's amazing how bad everyone is at predicting the future. Well, you look at it and you want to say, you've got to be kidding me. Why should we listen to anybody at this point?
Well, it's human experience. It's what we do as humans, and collectively as humans, as a human race. And so we hope for different things, and so many times it doesn't come on the right moment. You have to have patience.
Yeah.
And that's what investing is about. You've got to have patience. If you don't have patience, you shouldn't invest. You should sort of hunker down in your own little vault someplace.
Yeah, I think that's probably the way to look at it. Before I let you go, biases. I mentioned we all became behavioral economists after the financial crisis. We all said, this is not how the world is supposed to buy low and sell high, but it doesn't. Let's look at how people really think and how they react in a panic. Any advice for dealing with people's own biases, how people can recognize that and educate themselves better to be better investors?
Bob, I just think it's a matter of education, understanding how humans react to things. There's many stories and many factual things that have been written by psychiatrists, how people react to different news things. We generally want to panic, but then say, oh my God, I'm panicking. Do you ever recognize when I'm panicking? You do. People, they think about it, they'll recognize it, and then do just the opposite. Do not panic.
I think that's the right.
Because down markets are always so much more critical in terms of, they always go straight down, basically. And that's what really creates the panic. Markets, when they go up, chug up, take much slower to go up. Yeah. Much slower. That scale of uncertainty, you ride and climb.
I'm going to end with my favorite quote from the book. Audiences don't remember information, they remember the man. Now that was said to Charles by a fellow you hired back in...
Oh, I know, many years ago.
Many years ago to advise you on television commercials. Audiences don't remember information, they remember the man, and we certainly remember Charles Schwab. Thanks so much for coming down. It's been a wonderful following your career all these 30 years at CNBC. I've enjoyed it very much.
Thank you.
And continued success. It's a terrific book, folks. I read it over the weekend. It's called Invested by Charles Schwab. Everybody have a healthy, happy, and safe trading day.